Okay, let's talk about mastering uncertainty. I mean, navigating markets, your career, even life these days. It feels like piloting a ship through thick fog, right?
Absolutely. You've got these huge global shifts happening, technology changing everything constantly.
And maybe the old maps, they just don't quite seem to work anymore.
Yeah, exactly. So how do you even start building a system, a way to handle all that complexity, to understand the machine of reality, maybe, and maybe even thrive?
Well, for decades, Ray Dalio at Bridgewater Associates has been wrestling with exactly that. He's built this, well, arguably the most famous, most rigorous investment operating system out there.
And it's more than just investment rules, isn't it? It's like a whole philosophy, a framework turned into this structured, systematic way to make decisions, especially when things get hairy.
Exactly. And for this deep dive, we've really gone through the source material articles, analyses, Dalio's own stuff to pull out the key insights. Our mission here is to unpack this system. We want to understand its core logic, see how it actually holds up under pressure.
When chaos hits.
Right. And explore where it hits its limits, and maybe most importantly, figure out the single biggest lesson you can take away for your own decisions, whatever you're focused on.
And the sources make it really clear this whole thing is built on foundational pillars, a core way of seeing the world that shapes everything else.
Okay, let's dig into that first pillar then. The worldview. How does Dalio fundamentally see things, especially markets and economies?
Well, it really starts with this deep conviction that markets, economies, even organizations, and, life itself are basically complex machines.
Oh, okay. Not just random chaos.
No, not random. They operate with discernible cause and effect, like intricate clockwork, if you study it enough.
Right. There's that quote, something like life, management, economics, and investing can all be systemized into rules and understood like machines.
Yeah.
That really sums it up.
It does. The idea is you can map the gears, the levers, if you put in the work.
And central to this machine idea is his belief in cycles, isn't it?
Oh, absolutely central. He sees them everywhere. Huge historical cycles, economic cycles, debt cycles, the rise and fall of empires.
And this comes from a massive amount of research, right? Studying 500 years of history.
Yeah, exactly, to spot these recurring patterns.
And based on that history, he argues we're at a trickier phase now, like the later stages of a big cycle.
That's his view. It's why he says things like, the times ahead will be very different from anything that we have experienced in our lifetimes, because the cycle suggests more turbulence.
But it feels a bit Newtonian, like there are underlying laws governing complex stuff, if you can just figure them out.
That's a good way to put it. And it's quite different from a view that emphasizes, say, pure randomness or those black swan events that history supposedly can't prepare you for.
For Dalio, the past is the map, if you read it right.
Exactly.
Okay, so if the world is this machine running in cycles, how does he think about risk? Because, let's face it, markets feel pretty risky.
Well, risk is inherent, right? You can't just wish it away. But his view is that it is manageable. The key tool is radical diversification across uncorrelated assets. This is his famous Holy Grail idea.
Ah, yes, the 10 to 15 uncorrelated investment.
Right. The idea is you can dramatically cut your overall risk without sacrificing too much potential return. You're optimizing that return to risk ratio.
So, not avoiding risk, but kind of engineering your exposure to it.
Got it.
Now, what about the people, the humans operating these machines or investing in them?
Well, humans are seen as fundamentally flawed and biased. We're emotional creatures.
We mess things up.
We do. We fall into predictable traps, right? Overconfidence, confirmation bias, thinking we know more than we do that Dunning-Kruger thing.
And we know this isn't just theory for him. The sources really emphasize that big loss he took in 1982. He bet big, thought he knew, and was just spectacularly wrong.
Oh, yeah. A brutal, brutal lesson.
Yeah.
But formative? It drove home why you need explicit principles, systems, radical transparency.
Guardrails against our own worst instincts.
Exactly. Especially when things get stressful and emotions run high.
Which leads us neatly to maybe the most fundamental principle of all. Truth, or, as he puts it, an accurate understanding of reality is everything.
Yes. Embrace reality and deal with it. That's the principle. He says truth, or more precisely, an accurate understanding of reality is the essential foundation for any good outcome. It's the bedrock.
You can see how that drives the intense culture at Bridgewater, that relentless focus on finding out what's really true.
Mm-hmm. And finally, this whole system isn't meant to be static, right? It's designed to evolve, adapt, almost like nature.
Drawing from evolutionary ideas.
Very much so. That mantra, pain plus reflection, progress, that's pure evolutionary thinking applied to learning. Mistakes aren't just failures to regret, they're painful feedback.
Feedback you have to dissect to learn it and improve the system.
Precisely. He sees evolution as this single greatest force in the universe, the only constant driving everything.
So you take the painful lessons, you codify them into rules, so you hopefully don't make the same mistake twice. But reading through this, a question does pop up. If the system gets really, really good at avoiding the last war, the past kinds of pain, could it become, over-optimized, less ready for something totally new?
That's a really critical question. The system learns incredibly well from the map of history, but what if the future involves territory that's just not on any existing map?
A powerful structure, but yeah, maybe with blind spots for true novelty.
It's a possibility.
Okay, so that's the foundational worldview. The machine, the cycles, flawed humans needing truth, constant adaptation. That logically leads to pillar 2, the non-negotiable filters. What are the strict tests any strategy must pass?
Okay, first off, it absolutely has to be systematic and principles-based.
Yeah.
No gut feelings, no intuition driving decisions.
Rules rule.
Totally. Decisions flow from predefined, tested, codified rules. He says principles connect your values to your actions. The investment process isn't some kind of art. It's a machine you build and run based on explicit logic.
Which ties right back to that radical diversification via uncorrelated assets.
Yep, the holy grail again.
But it's not just owning different stuff, is it? It's about assets that behave differently in different economic weather.
Exactly. Whether growth is up or down, inflation hot or cold. Aiming for those 10 to 15 risk-balanced streams to hopefully cut risk by, around 80%.
But the sources point out a challenge here, right? Getting true uncorrelation is harder now.
Much harder. In a globalized world, central banks often move together, especially in crises. And when panic hits, correlations spike. Everything can fall together, even your hedges.
Right when you need them most. Your diversification suddenly doesn't diversify quite as much.
Precisely.
And this diversification is built on risk parity. It sounds technical, but it seems really important here.
It is crucial. Think of it this way. Instead of putting, say, equal dollars into stocks and bonds, you size them based on how much risk each one adds to the whole portfolio.
Okay, so stocks are usually more volatile, more risky than bonds.
Generally, yes. So to make the risk contribution equal, you'd probably need to put a lot more capital into the less volatile bonds, sometimes even using leverage on the bonds to get their risk level up to match the stocks.
So you're balancing the wobble each part brings, not just the dollar amount. Okay, that makes sense.
Exactly, balancing the risk dial.
What other filters does a strategy need to pass?
Relentless historical stress testing and understanding economic regimes. This is huge for Dalio.
Running simulations against the past.
Decades, even centuries of data. How would this strategy have done in the Great Depression? The 70s stagflation? The dot-com crash? He identifies these 4 key economic seasons.
Rising, falling growth. Rising, falling inflation.
Right. And strategies like the famous all-weather are built specifically to navigate all those seasons. History is the ultimate lab.
He really believes that. He said something like, portfolio construction is more important even than the picking of the best thing you like. The risk of being wrong is the problem.
It's about the resilience of the whole structure, not just individual winners. The structure needs to survive all weather.
Got it. And how are these strategies actually created? This involves the idea of meritocracy and radical openness, right?
Yeah, the famous or maybe infamous Bridgewater way.
Yeah.
Intense, transparent debate. Critiques fly openly.
Based on data and logic, not who's highest up the ladder. The quote is about employees openly criticizing ideas and assessing outcomes rigorously based on data, not feelings or hierarchy.
Right. The goal is that the best idea wins no matter who had it. But there's a potential tension highlighted in the material.
Which is?
Could this process accidentally create a kind of Bridgewater consensus? If the most believable people, the ones whose opinions carry weight, are those who've succeeded within the Dalio framework?
Are they less likely to truly challenge the core assumptions?
It's a potential risk. Could it subtly limit truly outside-the-box thinking?
Fascinating point. The system designed for openness might have its own subtle boundaries. Okay, so these filters, systematic rules, diversification, risk parity, history tests, meritocracy, they lead to things like the all-weather portfolio.
Exactly. The specific mix is secret sauce, of course, but the simplified version people talk about illustrates the principles.
Like 30% stocks for growth,
Right. Then maybe 40% long-term bonds for falling growth or deflation.
15% intermediate bonds for stability.
And then maybe 7.5% each in gold and commodities for inflation or currency worries.
Designed to perform okay regardless of the economic season.
That's the goal, consistency across environments.
Okay, we've got the theory, the filters. Now, pillar 3, the intellectual lineage. Where did Dalio pull all these ideas from? What's the source code?
It's a really interesting mix. History and economics obviously are massive.
Those deep dives into cycles, debt crises, empires.
Yeah, his book on navigating big debt crises is a direct result of that historical obsession. He echoes macro historians there.
And the whole machine metaphor that's clearly systems thinking, right?
Textbook systems thinking. Seeing the economy or markets as interconnected parts, inputs, outputs, feedback loops, trying to understand the whole by understanding the interactions. That quote about systemizing everything like machines fits perfectly.
Psychology is another huge piece, too.
Oh, definitely. That focus on cognitive biases, how our minds lead us astray. Principles is almost like a manual for overcoming emotional decision-making.
And things like radical truth and idea meritocracy are tools to fight confirmation bias, groupthink.
Exactly. He explicitly references things like Dunning-Kruger. He's thought hard about psychological pitfalls.
And the adaptive part, the pain plus reflection, that feels like it comes from evolutionary biology or natural philosophy.
I think so too. That view of evolution as a driving force, accepting pain as necessary for growth, it's got that natural philosophy vibe.
Quotes like, to be good, something must operate consistently with the laws of reality and contribute to the evolution of the whole, or look to nature.
Yeah, they show that influence clearly. It's a very adaptive worldview.
So he's pulling from macro history, systems science, psychology, even philosophy to build this framework. It's ambitious.
Highly ambitious. But the sources do caution about the risks of that kind of synthesis.
Like oversimplifying, or maybe misapplying ideas across different domains.
Exactly. Applying biological evolution directly to markets, for example, the mechanisms aren't quite the same. And again, that heavy reliance on history means the system is fundamentally optimized for understanding the past.
It's challenged by truly new things, stuff with no historical parallel, those unknown unknowns.
Right. Which brings us to how this system actually behaves under fire.
Okay, let's get practical. Part 3, the system under stress. And a key concept here is what we could call the temperament engine. How does the system handle the emotional side?
This is really interesting. It's about building a specific temperament into the system itself, not just relying on individual willpower.
So taking the emotion out.
Kind of. It's about subordinating individual feeling and intuition to the pre-agreed, tested system. The rules, the algorithms, they become the guide, especially when your gut is screaming sell or buy.
The system acts as an emotional circuit breaker.
That's a good way to think of it. And things like radical truth and open debate are vital here, especially during volatile times. They force objective analysis based on data, pushing back against panic or euphoria.
And that pain plus reflection progress idea is critical for temperament too, isn't it?
Absolutely. That 1982 loss wasn't just filed away, it was dissected. Why did it happen? What biases were at play? And the lessons were codified into principles to prevent similar mistakes under stress.
So it builds these learned responses, which might even be counterintuitive.
Often counterintuitive. When everyone else is panicking and selling, the system, based on its historical analysis and rules, might actually signal to buy certain things.
And the all-weather portfolio itself helps soothe nerves, right? Smoothing returns, reducing those big scary drops.
Exactly. It makes it psychologically easier to stick with the long-term plan, even when the news is terrifying. Less panic selling.
Plus, seeing the market as a machine helps shift the mindset. If it's malfunctioning, it's not an emotional crisis, it's a diagnostic problem.
Right. What gear broke? What does history say happens next in this kind of cycle? It fosters detachment.
But, there's always a but. The whole engine relies on the underlying map being right, doesn't it?
Completely. If the world fundamentally changes in a way history didn't prepare for, then the system's counterintuitive action could be exactly the wrong action for this new uncharted territory.
The system forces you to follow its logic, which is great, unless that logic is based on an outdated map of reality.
Precisely. Which makes the case study. Navigating the 2008 financial crisis so incredibly telling. That was the ultimate stress test.
And Bridgewater saw it coming, largely. The sources say they started sounding alarms way back in 2007.
They did. They saw the crazy leverage building up, looked at the historical parallels, especially past debt crises, and basically rejected the coming meltdown.
That fits their worldview perfectly right. The long-term debt cycle reaching its peak, the bubble bursting, the financial machine choking.
A textbook example for their framework.
And the filters kicked in. Heavy historical stress testing, comparing it to the Great Depression.
Absolutely. That validated their concerns. And the core principles, radical diversification, risk parity, were key to how they advised clients and managed their own funds.
All weather was designed for exactly that kind of environment, falling growth, falling inflation fears.
And their intellectual lineage paid off that deep grasp of debt history, the system's thinking to see how the financial machine was cracking. Indispensable.
Well, Wall Street was melting down. The Temperament engine kept them steady.
It seems so. Positioned for the downturn, using radical transparency internally to discuss the alarming data objectively.
And the results were pretty stunning. Average hedge funds lost, 20% in 2008?
Around that, yeah. But Bridgewater's main fund, Pure Alpha Skaden, was reportedly up over 9%. They protected their investors incredibly well.
That had to feel like a massive validation of the whole systematic approach.
Oh, undoubtedly. A huge win for the system. But there's that caveat again.
Right. 2008 was a credit crisis, a type of event with clear, painful historical precedents. It played right into the system's strengths.
Exactly. The nagging question is, how would this exact system handle a crisis driven by something completely different? Something with no real historical blueprint, like massive cyber warfare disrupting global finance, or maybe the economic fallout from truly runaway AI.
Unknown unknowns again. Which leads us nicely into looking at what the system doesn't seem to do well, or what it might deliberately avoid. Let's call it the anti-portfolio analysis, especially thinking about high-growth tech.
Yeah, this is interesting. Bridgewater, generally speaking, has been pretty cautious about hypergrowth tech stocks, especially when the market gets really excited about them.
Like the dot-com bubble back in the late 90s, or maybe some aspects of the recent AI frenzy.
Right. Dalio himself has drawn parallels between the current AI excitement and the 1998-99 period, warning that investors might be overestimating how many companies will actually succeed.
And this skepticism flows naturally from the system's core pillars, doesn't it?
It really does. The worldview emphasizes cycles, and mean reversion booms are often followed by busts. The filters are tough on novel tech, hard to stress test against history, high volatility messes with risk parity and diversification goals.
And the intellectual lineage, focused on those long historical economic patterns, might just struggle to properly value tech that could potentially break those patterns.
So this caution reveals some key traits of the system, a strong bias towards mean reversion, expecting things to snap back to historical averages eventually.
Difficulty with narrative, stocks companies valued more on future dreams than current profits.
Exactly. And it highlights the opportunity cost of prudence. Being careful means avoiding big losses, but it also means you might miss out on explosive, game-changing growth. Like that analysis said, risk aversion limits returns.
So it's maybe not a bug, but a feature. A deliberate trade-off, prioritizing resilience over chasing hypergrowth.
I think that's a fair way to see it. The system is built to understand established mechanics, even if it misses the first wave of something radically new. It tries to avoid being fooled by randomness, but maybe risks being fooled by transformation sometimes.
It's worth noting, though, Dalio does see technology as strategically vital. Right? His changing world order stuff talks about innovation.
Absolutely. He's flagged concerns about the U.S. falling behind China in AI application, for instance. The caution seems more focused on the timing, valuation, and predictability of investing directly in those high-flying, often unprofitable tech innovators.
It seems the system is better at analyzing the macro consequences of tech, how it impacts productivity, inflation, global power shifts, than it is at picking individual tech winners early on.
I think that's right. The consequences are more likely to fit into the existing machine and cycle frameworks.
Okay, let's really push this. Part 4. The limits and lessons. Time for a red team challenge. Where could this whole system, despite its power, really stumble or even break down?
Well, one major vulnerability has to be a prolonged breakdown of historical correlations.
So not just correlations spiking in a crisis, but something more fundamental changing.
Exactly. Imagine if unprecedented events, catastrophic climate change impacts, pandemics far worse than COVID, crippling cyber warfare, or maybe just sustained, bizarrely unconventional government policies fundamentally altered how different assets move together for years on end.
The diversification engine just sputters and dies.
Potentially, yeah. The system assumes the basic rules of economic environments and asset responses hold, more or less. What if factors outside the traditional models just rewrite those rules? The historical map becomes useless, or worse, misleading.
Okay, what else?
Accelerating nonlinear technological disruption. Think advanced AI, quantum computing. If these things change the fundamental cause and effect links in the economy too fast for the pain plus reflection cycle to keep up.
History becomes a poor guide.
Or even a dangerous one. The system learns evolutionarily, step by step. It's not built for sudden revolutionary shifts where the economic machine itself gets radically rewired overnight. The risk isn't just an AI bubble bursting. It's AI becoming the machine in a way we can't model from the past.
Then there's the complexity ceiling and true black swans, Taleb's idea.
Right. Can any system truly prepare for the completely unforeseeable high-impact event, or risks that just emerge unexpectedly from the sheer interconnectedness of everything? Diversification feels good, but maybe it's a false comfort if a novel systemic risk hits all your supposedly uncorrelated streams at once.
There's also a risk in the system itself, isn't there? Over-systematization.
Could be. Being so reliant on rules and principles might make it too rigid sometimes. Could it filter out genuine genius or those bold, concentrated bets on paradigm shifts that just don't fit the neat risk-return boxes?
Does trying to be a perfect machine mean missing crucial intuitive leaps? And we touched on this, is the idea meritocracy itself may be bounded by the core Dalio framework.
It's a valid question. And lastly, a huge one, geopolitical rupture.
Like the whole globalized system breaking down.
Yeah, a truly chaotic fracturing, hostile decoupling, assets getting seized, international institutions collapsing. The assumptions about global markets that underpin much of the system could just evaporate.
The machine was built and refined in the post-WWII era of growing globalization. A complete reversal could make its programming obsolete.
So the core fragility, maybe, is that assumption that an accurate understanding of reality can be achieved and projected using history and systems, if reality itself goes through a phase change with no precedent.
The whole beautiful structure is under immense stress. The historical definition of reality might just be wrong going forward.
It's the fundamental limit.
Okay, let's try to make this concrete. How would Dalio's system approach analyzing a modern, complex company like, say, Snowflake? Let's run a timelessness test.
Okay, Snowflake. Cloud data warehousing, consumption model, critical for data, AI. First, business model and role in the economic machine.
You'd see it as vital infrastructure, right?
Yeah.
Facilitating productivity, innovation, tying into his changing world order stuff about tech's impact.
Likely, he'd hunt for those cause-effect links. How does Snowflake actually boost corporate efficiency or growth?
Then, position in long-term cycles. How does that consumption model hold up in a downturn or a debt crisis? Does data spending dry up?
Good question. Evidence suggests it slows, at least. And how dependent is it on the current U.S. tech dominance, global data flows, geopolitical risks?
Now the big one, valuation against historical norms and principles.
Oof. Yeah. Snowflake's historical multiples have been sky high, often unprofitable on a standard JAP basis because of things like stock compensation.
Dalio's reaction?
Almost certainly highly skeptical. Those valuations would look incredibly stretched compared to historical benchmarks for similar tech phases. And the lack of consistent reported profit would be a major red flag. Fits right into his warnings about potential AI bubbles.
How would it fit within a radically diversified risk parity portfolio?
Tough fit. Its a high beta stock moves way more than the market. Its correlation with other tech stocks and overall market sentiment is likely very high.
So not uncorrelated.
Not really. And its high volatility means under risk parity, you'd have to allocate a tiny sliver of capital to it to keep its risk contribution in check, or use complex hedges. It probably wouldn't qualify as a good uncorrelated return stream for his system.
What about its competitive landscape and moat?
He'd dig into that. AWS, Google, Microsoft are fierce competitors. What makes Snowflake unique? Is its advantage in its tech, which could be fleeting? Or is it deeper switching costs, network effects? How vulnerable is it?
And maybe, given his focus on principles inside organizations, he might even look at Snowflake's own culture if doing deep diligence.
Possibly. So putting it all together, Dalio's probable conclusion on Snowflake.
Acknowledge its importance as tech infrastructure.
But likely be very, very cautious. The valuation, the lack of constant profits by his likely metrics, the difficulty fitting it into the risk parity diversification framework, major hurdles. He'd probably see it as symptomatic of a potential AI-driven bubble.
So, highly unlikely to be a core holding in something like all weather.
Extremely unlikely. More plausible, maybe, is gaining exposure to the broader themes: AI adoption, data growth through diversified baskets, indices, maybe even betting on countries successfully implementing the tech rather than individual high flyers.
The system is better at the macro consequences than the individual stock picking in these cases.
That seems to be its nature, yes.
Okay. We've built it, stressed it, found its edges. Let's wrap things up. Part 5. The core distillation. Synthesizing all this.
Right. So Dalio's system, it's this incredibly powerful, internally consistent machine, isn't it? It's brilliantly designed to navigate the kinds of uncertainty we've seen before, using history as its guide.
Translating that specific worldview into hard filters, engineering that calm temperament.
But that deep reliance on history and systematic learning is also its potential weakness. It struggles with, or even actively avoids, the truly unprecedented. It might miss transformative growth and remains vulnerable to shocks that history didn't prepare it for.
Its coherence is its strength, but maybe also its trap. If a core assumption about how the world works gets invalidated.
The whole thing is stress. It's a system optimized, maybe hyper-optimized, for a world that largely rhymes with the past.
Which brings us to the final question. After digging through all this, what's the single most powerful lesson we can take away? The one lesson.
Okay, I've had to boil it all down. The one lesson is the relentless, disciplined commitment to building and constantly refining a systematic process for understanding reality, learning from mistakes, and making decisions based on evidence and principles, not emotion.
So it's not just having principles, it's the active building of the decision-making machine itself.
Exactly. It's about systematization, turning painful lessons into explicit rules. It's about radical truth and open-mindedness, constantly stress-testing your own beliefs, seeking out disagreement, genuinely accepting you might be wrong.
Using historical perspective as a map, spotting patterns, cause and effect.
Right. And critically, embracing pain plus reflection, progress. Actively learning from failures, however bruising, to improve the machine.
And why is that the core lesson? Why is the process more important than any single rule?
Because the world changes, markets evolve, conditions shift, specific strategies decay. But a robust process for learning, adapting, and making principled, evidence-based decisions under uncertainty, that's timeless.
It forces humility.
Combats overconfidence.
Gives you a framework when others panic.
Exactly. It improves the decision maker and the decision-making process. That's what compounds positive results over the long run. It's like applying the idea of meritocracy to your own thinking.
So it transcends investing. It's really an approach to knowing. A way to get closer to what is true and act on it systematically, humbly, adaptively.
Striving to become a better machine for processing reality yourself. One painful reflection, one refined principle at a time.
Precisely.
Ray Dalio's system, forged from history, logic, and that relentless pursuit of truth, it offers this compelling blueprint for navigating a complex world. It shows the sheer power of systematizing how we learn and decide. Yet its limits are a crucial reminder too. Even the best systems, rooted in the past, face challenges when the future refuses to follow the script. So the challenge for all of us, for you listening, is to take these core ideas, that pursuit of truth, the value of reflecting on pain, the power of principles, and think about how to apply them. How could you build your own adaptive learning machine, not just for markets, but for the complex challenges in your career, your personal growth, or even just for making better sense of this fascinating, messy, constantly changing world around us?